On the way up, the market feels calm, almost polite. Stocks rise a little today, a little more next week. Analysts nod approvingly. Headlines say the economy is strong. Then one morning, the screen turns red. 5% down, then 10. Billions vanish before lunch. And suddenly everyone asks the same question. Why does the market fall so much faster than it rises? It feels irrational, but it isn't. Because markets climb on patience, but they crash on panic. And panic moves fast. Think about how a normal bull market works. Investors slowly gain confidence. A company reports strong earnings. Funds buy more shares. Prices drift upward. More people notice the trend. Money trickles in over months, sometimes years. Optimism grows carefully. Investors test ideas, adjust portfolios, and wait for confirmation before committing serious capital. It's slow. But when markets turn, the psychology flips instantly. Now the question isn't, how much can I make? It's, how much can I lose? And that single shift changes everything. When prices start falling, fear spreads faster than optimism ever did. Investors who plan to hold for years suddenly think about tomorrow morning. But psychology alone doesn't explain the speed of crashes. The real accelerator is something most people rarely think about: leverage. Leverage is borrowed money used to buy investments. Hedge funds use it. Banks use it. Even regular investors use it through margin accounts. In good times, leverage amplifies profits. In bad times, it forces decisions. Because if the value of your investment drops too far, your broker demands more cash immediately. This is called a margin call. And most investors don't have spare cash ready to go, so they sell. Those forced sales push prices down further, which triggers more margin calls, which forces more selling. It becomes a chain reaction. In 2008, leverage in the housing market helped turn falling home prices into a global financial crisis. In March 2020, markets fell over 30% in just weeks as funds rushed to unwind positions. The system didn't simply lose confidence, it mechanically accelerated the fall. There's another twist. When markets are rising, buyers are everywhere. Everyone wants exposure to growth. But during a crash, buyers step aside. They wait, they hesitate, they protect their cash. Suddenly, there are far more sellers than buyers. Prices have only one direction left: down. Fast. So while markets spend years building wealth, they can destroy it in days. Not because the system is broken, but because it's functioning exactly as designed. Which raises an uncomfortable thought. If the next crash will also move at lightning speed, how much hidden leverage is quietly sitting inside the system right now, waiting for fear to flip the switch?